Imagine this. You wake up on a Tuesday morning. You have not done a single thing for work. And while you were sleeping, your brokerage account just got paid. A dividend just landed. Real money. Deposited automatically. No effort required. That feeling? That is why millions of investors are obsessed with dividend stocks, passive income, cash flow, getting paid to hold. But here's the question nobody wants to answer honestly. Does chasing that feeling actually make you richer? Or is it one of the most psychologically seductive and quietly expensive mistakes in personal finance? Because the data tells a story most dividend investors do not want to hear. And the psychology behind why people still choose dividends anyway, that is even more revealing. Let us get into it. This is one of the most debated topics in investing. Dividend stocks versus index funds. Income investing versus total return. The cash flow crowd versus the compound growth crowd. And the internet will have you believe this is a close call. That it really depends. That both are fine strategies and you just pick what suits your personality. I am going to push back on that. Because when you look at the actual evidence, the returns data, the tax implications, the behavioral research, the picture becomes much clearer. And when you understand the psychology driving the dividend preference, you start to realize this is not really an investing debate at all. It is a debate about how our brains are wired, about what feels good versus what actually works, and about one of the most powerful cognitive biases in personal finance. By the end of this video, you are going to have a clear answer, and you might be surprised by what it is. Let us start with the basics, because most people do not actually understand what happens when a company pays you a dividend. Here's the reality. When a company pays a dividend, it transfers money out of its own balance sheet and into your account. The moment it does that, the value of the company drops by exactly that amount, every single time. Think about it like this. You have a jar with 100 pounds in it. The jar represents your investment. The company reaches into the jar, takes out 4 pounds, and hands it to you. You now have 4 pounds in your hand and 96 pounds left in the jar. Your total wealth has not changed. You have simply moved money from one pocket to another. This is called dividend irrelevance theory, first formalized by Nobel Prize-winning economists Modigliani and Miller. Before fees and before taxes, a dividend payment is a financial non-event. The stock price drops by the dividend amount on the ex-dividend date almost every time. This is not controversial. It is accounting. Money leaves the company, and the share price reflects that. Total wealth is unchanged at the moment of payment. Now, dividend investors will say, yes, but the cash in my hand is real. I can reinvest it or spend it. And that is true. But here's the thing. You can replicate that cash flow from any investment at any time, simply by selling a small number of shares. You do not need the company to force a distribution on you to access your own money. This is called a synthetic dividend, or a homemade dividend. And it is mathematically identical to receiving an actual dividend, except with one crucial difference we will get to in a moment. Counterintuitive idea. Receiving a dividend does not make you richer. You already had that money before. It was simply sitting inside the company's value. The dividend payment is not a bonus. It is a withdrawal from your own investment. Here is where dividends go from being financially neutral to actively expensive. Tax. In most countries, dividends are taxed as income in the year you receive them, whether you wanted the cash or not. You did not choose to take money out. The company made that choice for you, and now you owe tax on it. Compare that to a growth-focused index fund. If the fund reinvests earnings internally and the share price rises, you do not owe a penny in tax until the day you actually choose to sell. That could be 10, 20, or 30 years from now. And in the meantime, you are compounding on money that would otherwise have gone to the taxman. This is not a small difference. The ability to defer taxes is one of the most powerful mathematical advantages in long-term investing. When you receive a forced dividend, you lose that control. You lose that deferral, and over decades, that drag compounds against you. Vanguard researchers modeled the long-run impact of tax drag on dividend portfolios. versus total return portfolios held in taxable accounts. Across 30-year periods, the tax-efficient total return approach produced meaningfully higher after-tax wealth, not because the underlying returns were better, but because of when and how taxes were triggered. Now, there is a workaround. Hold dividend stocks inside a tax-sheltered account like an ISA, a 401k, or a pension. Inside those wrappers, the tax drag disappears. But then you lose one of the core arguments dividend investors make, that you can live off the income stream without touching your capital. Inside a tax wrapper, you are not actually receiving spendable income directly. You are still accumulating. So the argument shifts. Practical takeaway. If you are holding dividend stocks in a taxable account, calculate your real after-tax yield, not the headline number. For a 4% dividend yield with income tax at 40%, your real net yield might be closer to 2.4%. Then ask yourself, is that still worth the concentration risk you're taking to get it? Okay, so if dividends are mathematically neutral at best and tax inefficient at worst, why do so many smart, educated investors still chase them? This is where it gets genuinely fascinating. The answer comes down to two deep cognitive biases documented by behavioral economists. The first is called mental accounting. This is the psychological tendency to treat different pools of money as fundamentally different, even when mathematically they are identical. Research by behavioral finance pioneer Richard Thaler showed that people treat dividend income as earned money, safe to spend, feel good to receive, while treating capital gains as something more abstract and less real. A dividend hitting your account feels like getting paid. Selling shares to generate the same cash feels like eating into your wealth. But here's the truth. They are the exact same thing. A £500 dividend and selling £500 worth of shares both reduce your portfolio's total value by exactly the same amount. The only difference is how your brain categorizes them. Thaler's mental accounting research showed that people have a powerful bias towards spending income flows, dividends, interest, salary, while leaving capital untouched. This creates an emotional sense of financial security that has no mathematical basis. Your brain is running a psychological accounting system that does not match the real numbers. The second bias is loss aversion, one of the most documented findings in behavioral economics. Kahneman and Tversky showed that psychologically, losses feel roughly twice as painful as equivalent gains feel good. When markets fall, and they always fall eventually, dividend investors feel a specific kind of comfort. The portfolio might be down 15%, but the dividend keeps coming in. Cash keeps arriving, and that cash acts as a psychological anchor, a signal that says, you are still okay, you are still getting paid. That feeling is real. Neurologically real. The dopamine hit of receiving cash is a tangible experience, but financially, it is disconnected from your actual wealth position. The dividend did not protect your portfolio. The underlying value still fell. You just received a cash payment that made it feel better. Practical takeaway. Next time you feel drawn toward dividend investing, ask yourself honestly, am I choosing this for the math or for the feeling? Both are valid starting points, but only one should drive your strategy. If the appeal is emotional comfort during volatility, that is a behavior problem, not a portfolio problem. And behavior problems need behavior solutions, like automating investments and avoiding checking your portfolio during downturns, not necessarily changing your asset strategy. So what does the evidence actually say about index funds? It is almost comically strong. Over almost any 15-year period in modern market history, a low-cost total market index fund has outperformed the vast majority of actively managed funds, including most dividend-focused strategies. The S&P 500 has historically delivered roughly 10% annualized returns before inflation, and crucially, it does this while automatically including everything: high dividend payers, growth companies, value stocks, the entire market. When you buy a dividend ETF or build a dividend portfolio, You are voluntarily concentrating into a subset of the market that often excludes high-growth companies. Technology, biotech, early-stage growth businesses, companies reinvesting every pound of profit back into future growth. And the irony is brutal. The companies paying the highest dividends are often the ones growing the slowest. And the companies growing the fastest, the ones building the wealth of tomorrow, often pay no dividend at all. So by chasing income, you may be systematically avoiding the exact companies most likely to compound your wealth aggressively over the next 20 years. Spiva data, S&P's own research into active versus passive performance, consistently shows that over 15-year periods, most actively managed funds underperform their benchmark index after fees. Dividend-focused funds are not immune to this pattern. The evidence for passive index investing is not opinion. It is one of the most replicated findings in financial research. And then there are fees. A broad market index fund might cost you 0.03 to 0.07% per year. A managed dividend fund might cost 0.5 to 1.5%. On a £100,000 portfolio over 30 years, that fee difference compounded could represent tens of thousands of pounds in lost wealth, not lost to bad investing, lost to fees, quietly, every year. So let us be honest about what this debate really is. It is not actually about dividends versus index funds. It is about what we want to feel versus what actually builds wealth. Dividends feel like income. They feel like safety. They feel like proof that your money is working, that feeling is real. And it matters, because a strategy you can stick with is better than a theoretically perfect one you abandon when markets become difficult. But feelings and strategy are not the same thing. And when you let the feeling drive the strategy, when you build a portfolio around the emotional comfort of cash payments instead of the mathematical reality of total returns, you pay a price. In taxes, in concentration risk, in fees, in slower compounding. The evidence points clearly in one direction. For most investors building wealth over the long term, a low-cost, diversified total market index fund, ideally inside a tax-sheltered account, ideally automated, ideally ignored, will outperform most dividend strategies on an after-tax, after-fee basis. Not because it feels better, because it does not feel like anything. And that is exactly the point. The best investment strategy is often the one that removes your brain from the equation as much as possible. Because your brain, brilliant as it is, was not designed for long-term compounding. It was designed to respond to immediate rewards. And dividends are an immediate reward. An index fund compounding silently for 25 years is not. So here's the question I want to leave you with. When you look at your portfolio, or the portfolio you want to build, how much of it is designed for your financial future? And how much of it is designed for your psychological comfort in the present? Because the gap between those two things is where most wealth gets quietly left on the table. And now that you can see the gap, you can do something about it.